All right, buckle up because we're diving into a topic that might sound a little, well, accounting eye on the surface, but trust me, it's a full throttle thriller of human behavior, high stakes, and intricate systems. Welcome to another deep dive where we cut through the noise to give you that shortcut to being truly well informed. Today, we're unpacking financial fraud. Specifically, we're peering through the eyes of an auditor. This deep dive is your shortcut to understanding how these financial detectives identify, assess, and respond to the subtle and often audacious signs of deception in the financial world.
And what's fascinating here is the sheer audacity of it all and the inherent challenge. Fraud, by its very nature, is a master of disguise. It's intentionally hidden, meticulously designed to mislead, to go completely undetected. This makes its discovery one of the most critical and complex aspects of financial oversight. We're going to explore precisely why it's so incredibly difficult for even the most meticulous auditors to uncover every single instance of fraud and what systematic, strategic measures are put in place to address this constant evolving game of cat and mouse played out with numbers.
So let's start at the very beginning, because when we talk about misstatements and financial numbers, people often use words like error and fraud interchangeably. But for an auditor, that distinction is absolutely everything. It's not just about getting a number wrong, is it?
No, no. The real heart of the matter, the absolute game changer, is intention.
Ah, intention. Okay.
Think of it this way. An error is an unintentional misstatement or omission in the financial statements. It's a genuine mistake.
Like a typo.
Exactly, like a typo. Imagine a clerk accidentally transposing two numbers in a large spreadsheet, turning, say, $5,600 into $6,500. That's an error, pure accident. Or perhaps management makes an honest but ultimately inaccurate accounting estimate. They genuinely believed a piece of equipment would last 10 years, but it unexpectedly broke down after 5. That leads to an unintentional misstatement of depreciation.
Okay, so an honest mistake in judgment.
Right. Errors can also stem from a simple misunderstanding or the unintentional misapplication of complex accounting principles. I mean, some of this stuff is complicated. The crucial point is there's no malice, no hidden agenda. It's simply human fallibility or a genuine oversight.
So if an error is accidental, then fraud must be the opposite when someone deliberately tries to deceive.
Precisely. Fraud, in the context we're discussing, is defined as an intentional act involving deception that ultimately results in a misstatement of the financial statements.
Intentional deception. Got it.
And this act can be perpetrated by anyone within or even outside the organization. It could be one or more individuals among senior management, those charged with governance, like the board of directors or an audit committee.
So people at the top?
People at the top, right down to regular employees or even external third parties collaborating with insiders. The critical differentiator, as you so rightly put it, is that deliberate use of deception. It's not an accident. It's a calculated, conscious effort to manipulate the financial picture.
Why would they do that?
Well, usually to achieve some kind of personal or corporate advantage, or maybe to conceal something damaging. This active intent makes it fundamentally different from a simple error and far, far more challenging for an auditor to detect.
That distinction really crystallizes it. So if it's intentional, what does that look like in the gritty reality of financial statements? Are there different ways people commit this kind of financial deception?
Yes, absolutely. We typically categorize financial fraud into two broad, distinct types, each with its own characteristics, objectives, and common perpetrators. We differentiate between fraudulent financial reporting and misappropriation of assets, which is also often referred to as defalcation.
Let's unpack fraudulent financial reporting first. That sounds like the headline-grabbing corporate scandal stuff we hear about, where CEOs end up in jail.
You're absolutely spot on. That's often the realm of fraudulent financial reporting. This involves intentional misstatements or omissions designed specifically to deceive the users of financial statements.
So investors, banks.
Exactly. Investors, banks, regulators, or even the public.
Yeah.
The primary perpetrators here are almost always management.
Why management specifically?
Well, because management has the most direct control over how the company's financial story is crafted and presented. They might be under immense pressure, to meet aggressive earnings targets, to secure crucial loans, to boost the company's stock price, or even to hit performance metrics that trigger massive bonuses.
Ah, the incentives.
Right. They'll manipulate the numbers to achieve those goals, even if it means bending or, well, breaking the truth.
So how do they actually do that? What are the specific tactics to paint this false picture?
They employ a range of methods, often creatively. One common tactic is the manipulation, falsification, or alteration of accounting records or supporting documents.
Like literally changing the evidence.
Literally changing the evidence. Backdating invoices to pull revenue into an earlier period, creating entirely fictitious sales orders to inflate top-line numbers, or subtly altering expense receipts to reduce reported costs. Essentially, they're tampering with the building blocks of the financial statements. Another method is misrepresentation in or intentional omission from the financial statements of events, transactions, or significant information.
So hiding the bad stuff.
Exactly. Hiding the bad stuff or exaggerating the good. They might selectively leave out crucial negative information, like a pending multi-million-dollar lawsuit the company's about to lose, or a significant long-term liability they don't want anyone focusing on. Yeah. Or they might present revenue from a deal that hasn't actually been finalized, making the company look far healthier than it is. It's about crafting a narrative by what you include and, more nefariously, what you intentionally leave out.
Sneaky.
Very. And finally, there's the intentional misapplication of accounting principles relating to amounts, classification, presentation, or disclosures. This isn't an accidental misunderstanding of GAAP generally accepted accounting principles. It's a deliberate choice.
How so?
They might choose an accounting method that, say, obscures debt, artificially inflates assets, or prematurely recognizes revenue before it's actually earned. For instance, classifying a one-time gain from selling an old factory as recurring operating revenue to suggest sustainable growth.
Making it look like business is booming when it's just a one-off.
Precisely. Or capitalizing routine expenses that should be immediately expensed to artificially boost current profits. It's all about making the company appear financially robust and successful on paper to external parties, regardless of the true underlying economics.
Okay, so that's essentially cooking the books to make the company look better. Theft.
It is, absolutely. Misappropriation of assets, or defalcation, involves the theft of an entity's assets that ultimately causes the financial statements not to conform with GAAP.
So the goal here isn't perception, it's personal gain.
Exactly. Unlike fraudulent financial reporting, where the goal is often to make the company look better to outsiders, here the goal is typically personal gain, and the company is usually directly harmed by the loss of its assets. This is where the money literally walks out the door.
And who are the perpetrators in these cases? Is it always a low-level employee grabbing cash from the till?
Not always, no. These acts can be perpetrated by regular employees, sure, but also by management or even by third parties acting in collusion with insiders. The scale and sophistication can vary dramatically.
Yes.
Well, it could be something seemingly minor, like an employee submitting fake expense reports for travel they never took, or claiming reimbursement for personal purchases as business expenses.
The classic padding the expense report.
Right. Or it could be far more significant, like a bookkeeper systematically siphoning small amounts of cash from a petty cash fund over years, something that flies under the radar. Or a sales manager diverting customer payments directly into their personal bank account.
Wow.
It also includes causing the entity to pay for something it has not received. Think about creating fictitious vendor invoices for services never rendered or goods never delivered, and then collecting the payment themselves.
So setting up fake companies.
Could be. Or maybe a manager secretly approving invoices from a shell company that they own. The key is that the company's assets are unlawfully taken or used for personal benefit. And this theft, even if subtle at first, eventually impacts the accuracy of the financial statements, perhaps by reducing cash balances or inflating expenses, causing the financial picture to be misrepresented.
Okay, so we've defined what fraud is intentional deception and the different forms it can take, from corporate deception to outright theft. But why does it happen? Is there some common thread, a set of underlying conditions that are usually present when someone commits fraud?
That's an excellent question, and it brings us to a foundational concept in fraud examination: the fraud triangle.
The fraud triangle. Sounds ominous.
Kind of is. It isn't a rigid formula, but it brilliantly highlights the three conditions that are generally present when fraud occurs. Auditors specifically consider these factors when assessing the risk of fraud. It's an incredibly insightful model because it helps us understand the psychology and circumstances surrounding these deceptive acts.
So what are the three critical corners of this triangle? Walk us through them.
Okay, the first side is incentives pressures. This is the compelling reason or motive for someone to commit fraud. It's the why.
The trigger.
Exactly, the trigger. These pressures can be incredibly diverse and intense. On a personal level, it could be crushing financial debt, maybe a gambling problem, an unexpected medical crisis, or simply the desperate need to maintain a lavish lifestyle that far exceeds their legitimate income.
Keeping up appearances.
Right. For management, the pressure often comes from within the organization or from demanding external market expectations. There might be aggressive financial targets to meet, like quarterly earnings goals that seem impossible to achieve legitimately.
Pressure from Wall Street, maybe.
Absolutely. Executives might have significant bonuses tied directly to reported profits, or their personal wealth from stock options could be underwater, creating a powerful incentive to manipulate numbers to artificially boost the share price. Unrealistic expectations from investors or analysts can also drive management to commit fraud. These incentives or pressures are often inherent risk factors, meaning they exist before any internal controls are considered.
So someone has a compelling reason to do it, but they also need the ability, right? They need an opportunity.
Exactly. That's the second, equally crucial side of the triangle. Opportunity arises from a lack of effective controls, or the ability of an individual to override those controls.
The how.
The how. Even if someone is under immense pressure, they can't commit fraud if there's no viable way to do it undetected. This often stems from weak internal controls within the organization.
Like what?
For instance, if there's no proper segregation of duties, meaning one person handles everything from authorizing transactions to recording them and reconciling accounts, that creates a clear, unobstructed pathway for fraud.
Too much power in one person's hands.
Precisely. Poor oversight from management or the board can also present opportunities, as a lack of scrutiny can embolden potential fraudsters. Complex or unusual transactions that are difficult to track or understand can unintentionally create loopholes. And most critically, management, especially at senior levels, often possesses the inherent ability to override even the strongest internal controls.
How can they just override controls?
Well, they might instruct subordinates to ignore established procedures, or they themselves might simply bypass the system entirely. Their authority allows it. This makes it incredibly difficult for standard controls to prevent their fraudulent acts. These opportunities directly relate to the specific weaknesses or conditions within the system of internal control that enable fraud to occur or remain concealed.
So we have the reason, the pressure, and the way the opportunity. What's the final and perhaps most chilling piece of this puzzle? The justification.
That's the third and arguably most psychological side, rationalization attitude. This is the perpetrator's attempt to justify their fraudulent behavior to themselves, or maybe a general attitude that allows them to engage in dishonest acts while somehow maintaining a semblance of integrity in their own eyes.
How they make it okay in their own head.
Exactly. It's what allows them to sleep at night. People who commit fraud often don't view themselves as criminals. They create elaborate justifications for their actions.
Like what kind of justifications?
Common rationalizations include things like, I'll pay it back, this is just temporary, suggesting they intend to undo the harm and therefore it's not really theft. Or, they owe me this, feeling a sense of entitlement due to perceived unfair treatment or being underpaid.
Right, a feeling of being wronged.
Sometimes it's everyone else is doing it, creating a sense of normalized, unethical behavior within the organization.
Oh.
Or there might simply be a general disregard for ethical conduct, a belief that rules are for other people, or that the organization's goals like hitting net earnings target outweigh any ethical considerations.
The ends justify the means, sort of thing.
Pretty much. This kind of attitude often develops in environments with lax ethical standards or weak leadership that doesn't prioritize integrity. Auditors really focus on these factors when assessing fraud risk. While the presence of even one condition can signal a potential risk, the likelihood of fraud significantly increases when all three, pressure, opportunity, and rationalization, are present and align. It creates a perfect storm for deception.
But it's not proof.
No, it's important to note, the mere presence of these factors doesn't mean fraud has occurred. But it certainly raises serious red flags that auditors simply cannot ignore. Conversely, the absence of obvious factors doesn't mean no fraud risk exists either. Even one strong condition can be enough.
So if auditors are trained to look for these fraud triangle factors and they have all these procedures, why don't they catch every single case of fraud? It seems like they should if they follow all the rules, right?
That's a common and completely understandable question, but it highlights a critical concept in auditing. the idea of reasonable assurance.
Reasonable assurance, not absolute assurance.
Exactly. Auditors are there to provide reasonable, not absolute assurance that financial statements are free of what we call material misstatements, meaning errors or fraud big enough that they would actually change a user's decision, like whether to invest or lend money.
Okay, material is key there, not every little thing.
Right. And the simple truth is, even a perfectly planned and meticulously executed audit can, and sometimes does, fail to detect fraud.
And why is that? What makes it such a difficult pursuit?
There are several inherent limitations that make this a tough game. First and foremost, the concealment aspects of fraud are paramount. Fraud is fundamentally designed to be hidden, right?
Yeah, that makes sense.
To leave no trace, to create a false trail. Unlike an accidental error, which is often just, well, an accident, fraud involves deliberate, often sophisticated attempts to cover it up, to mislead, to fabricate evidence. This intentional concealment makes it inherently more challenging to uncover.
So it's actively fighting back.
In a way, yes. Secondly, auditors must apply significant professional judgment in evaluating fraud risk. It's not a simple checklist you tick off. It requires nuanced assessment of complex situations, and judgment by its very nature isn't infallible. People can make mistakes, even experienced auditors. Furthermore, the risk of not detecting a material misstatement that results from fraud is significantly higher than the risk of not detecting one that results from error.
Why hire for fraud?
Directly because of that intentional concealment we just discussed. An error, once discovered, is usually easily corrected and rarely hidden deliberately. Fraud, however, is a conscious act to mislead, and perpetrators will actively work to evade detection.
So if management is involved, it's like trying to find a ghost in your own house even harder.
Precisely. The risk of not detecting a material misstatement resulting from management fraud is considerably greater than that for employee fraud,
Why is that again?
because management is in a unique and incredibly powerful position. They can manipulate accounting records at a high level, they can present fraudulent financial information that appears legitimate on the surface, and most critically, they have the authority to override controls.
Right, the override capability.
Think of it like building a super secure vault, but the person with the master key, who can open it any time they want, is the one you're trying to keep out. An employee might have to find a way around a control, but a CEO can effectively suspend or ignore control for their own purposes.
Making it incredibly difficult to spot.
Extremely difficult for standard audit procedures to uncover. Imagine a senior executive overriding the usual approval process for a large fictitious transaction just to boost revenue numbers. How do you catch that easily? Other factors also contribute to this difficulty. The skillfulness of the perpetrator plays a huge role. A sophisticated, intelligent fraudster who understands accounting loopholes is far harder to catch than someone making a simple theft.
Experience matters, even for the bad guys.
Unfortunately, yes. The frequency and extent of manipulation also matter. Small, frequent manipulations over a long period can fly under the radar, as can highly complex, one-off manipulations designed to be untraceable. The degree of collusion involved is another major hurdle. When multiple individuals conspire, be they managers, employees, or even third parties, it creates a tangled web of deceit that is immensely challenging for an auditor to untangle.
Because everyone is covering for each other.
Exactly. Each person involved helps to legitimize the fraudulent activity and corroborate false evidence. Finally, the relative size of the individual amounts manipulated and the seniority of the individuals involved also dictate detection difficulty. Smaller individual amounts might not trigger materiality thresholds, and frauds committed by highly senior individuals often carry the authority or influence to suppress questioning or manipulate evidence more effectively.
That really clarifies why it's such a high-stakes, difficult game. So, with all these challenges, who is actually responsible for fraud prevention and detection in a company? Is it management, or is it the auditor who takes the fall? There seems to be some confusion there.
It's a very important clarification to make, as the responsibilities are distinct and complementary. Management holds the primary responsibility.
Okay, so it starts with management.
Absolutely. It is management's job to design and implement robust programs and controls that are effective in preventing, deterring, and detecting fraud. This isn't just a suggestion. It's a fundamental aspect of their fiduciary duty to the organization and its stakeholders.
Their legal and ethical obligation.
That's right. Their obligation to act in the best interest of the company. They are on the front lines, creating the ethical environment and the systems that should make fraud difficult, if not impossible, to commit and conceal. This is a proactive role, establishing the defenses.
And the auditor's role then is more like the independent check, the quality assurance.
Exactly. The auditor's responsibility is to plan and perform the audit to obtain reasonable assurance that the financial statements are free of material misstatement, whether that misstatement is caused by error or by fraud.
Reasonable assurance again.
Always reasonable assurance. As a core part of their audit planning, auditors must specifically assess the risk of material misstatement due to fraud. This assessment then directly informs the design of the audit procedures they will perform.
So the risk assessment drives the audit plan.
Correct. And it's crucial to understand that this fraud risk assessment isn't a one-time event, it's an ongoing process. It must be considered and reevaluated in every single phase of the audit, from initial planning all the way through to the final review of evidence.
It's not just a box to tick at the start.
Not at all. While management builds the castle's defenses to prevent fraud, auditors are there to test those defenses and search for any weaknesses or breaches that might have led to material misstatements.
This sounds like auditors need to be part detective, part psychologist, part accountant. What's the core attitude, the essential mindset they need to bring to every engagement to deal with something so elusive and intentionally hidden?
That core attitude is called professional skepticism, and it is absolutely vital. It's the auditor's superpower, really.
Professional skepticism. Okay.
It means maintaining a questioning mind and a critical assessment of all audit evidence. It's about not taking anything at face value, even when presented by seemingly trustworthy individuals.
Don't trust, verify.
Essentially, yes. But it also includes considering whether any unconscious or conscious biases might be impacting their own judgment, like an unconscious tendency to trust a long-term, seemingly impeccable client just because they've never had issues before.
So challenging their own assumptions, too.
Absolutely. A truly skeptical auditor understands that fraud can occur, regardless of any past positive experience with the entity or any personal belief about management's honesty and integrity. They must never rationalize away or dismiss information that could be indicative of fraud.
Like a good poker player.
That's a great analogy. You assume everyone at the table could be bluffing, even your best friend. You don't accuse them outright, but you constantly watch for tells and always ask for the cards to be shown.
Okay, I get that. Constant vigilance.
Exactly. This means auditors remain vigilant, always probing, even with clients they've worked with for years and consider highly reputable. They are constantly asking, what if, and show me the evidence. They dig deeper when something feels off, rather than simply accepting surface-level explanations. This mindset is the auditor's most powerful tool against intentional deception.
So, armed with this skepticism, what are the actual steps, the playbook, auditors are required to follow to address fraud? Is there a set framework?
Yes, there is. Building on that professional skepticism, the auditing standards outline 6 core procedures that auditors must follow to address fraud risk throughout an engagement.
Okay, what are they?
First, they must discuss fraud risk with engagement personnel, the audit team itself. Second, they need to obtain information to identify specific fraud risks within the client's operations. Third, they must then assess those identified fraud risks and develop an appropriate response tailored to the client.
Assess and respond. Makes sense.
Fourth, they must continuously evaluate audit evidence regarding fraud as they perform their work. Fifth, they are required to make appropriate communications about fraud to the right parties if it's found or suspected. And finally, sixth, they must document the auditor's consideration of fraud comprehensively throughout the entire process.
Document everything.
Everything. These 6 steps form the comprehensive.
So before they even start looking at numbers or documents, auditors have a mandatory huddle, almost like a pre-game strategy session. What exactly is discussed in this critical planning meeting among the audit team? It sounds like more than just a quick chat.
That's right. It's far more than a quick chat. It's a crucial first step. A detailed discussion of the potential for material misstatement due to fraud is required as part of audit planning.
Required, not optional.
Absolutely required. The purpose is to get all key audit team members, including the engagement partner and sometimes specialists, on the same page, bringing diverse perspectives and experiences to the table. This discussion is effectively a brainstorming session focusing on several key elements unique to that specific client.
So what are they brainstorming?
They brainstorm specific scenarios, how and where the financial statements might be susceptible to material misstatement due to fraud. This includes considering complex or subjective areas like related party transactions, where deals might not be at arm's length.
Deals with friends or family of the company?
Exactly. Those can often be a vehicle for disguised fraud. They also delve into how management, specifically, could perpetuate and conceal fraudulent financial reporting. For example, by intentionally omitting or presenting incomplete or inaccurate disclosures in the footnotes, which could be just as misleading as misstated numbers,
Hiding things in the fine print.
or just leaving things out entirely. They discuss how assets could be misappropriated within that specific entity's unique operations. Is it cash that's vulnerable? Inventory, payments. And critically, they consider how the financial statements could be manipulated through management bias and accounting estimates and significant accounts and disclosures.
Estimates seem like a squishy area.
They can be. Management has discretion in making estimates, like how long an asset will last or how much inventory is obsolete. And this discretion, if abused, can be a subtle but powerful way to inflate profits or hide losses.
So they really try to think like a fraudster for that client.
That's a good way to put it. Beyond brainstorming specific scenarios, the discussion also includes a strong emphasis on the importance of maintaining professional skepticism throughout the audit, reminding everyone to keep that poker face attitude.
Reinforcing the mindset?
Exactly. They carefully consider factors that create incentives or pressures to commit fraud and provide an opportunity for fraud to be perpetrated, or that indicate a culture or environment that enables management to rationalize committing fraud. This is where the fraud triangle comes alive in a practical team setting applied to the specific client circumstances.
Bringing the triangle to life.
Right. And critically, they discuss the ever-present risk of management override of controls, acknowledging that even the strongest systems can potentially be bypassed by those at the top. This initial discussion also covers how the auditor might specifically respond to any identified fraud risk, shaping the entire audit strategy.
And this isn't just a one-off meeting.
No, it's not just a single meeting. Communication about fraud risk is designed to continue throughout the audit, adapting as new information comes to light. It's a dynamic conversation.
That's a truly comprehensive brainstorming session to kick things off. Once they've had that crucial discussion, how do auditors gather the actual intelligence, the real clues on potential fraud? What are their investigative methods?
Okay, the next phase involves actively obtaining information to identify potential fraud risks. There are 3 primary avenues for this, each providing a different lens on the organization.
3 avenues. What's the first?
First, auditors conduct inquiries of entity personnel regarding their views of fraud risk. This means directly asking a wide range of individuals within the company about their perceptions, suspicions, and knowledge related to fraud.
So talking to people, not just looking at numbers.
Absolutely. And it isn't just asking senior management. Auditors inquire of employees involved in financial reporting, operational personnel who see the day-to-day workings on the ground, internal auditors who have their own independent perspective, in-house legal counsel, and crucially, those charged with governance, like the audit committee, who oversee management.
A wide net of conversations.
Exactly. The goal is to get diverse viewpoints and uncover potential red flags that might not be visible from just looking at numbers or talking to the top brass.
What kinds of questions do they ask these different people? Are they like a financial investigative journalist?
They absolutely are, in a sense. They ask about the overall risk of fraud within the company, whether there have been any identified or even suspected instances of fraud, and how the company identifies and responds to fraud risk itself.
Okay.
They'll also inquire about the extent of oversight of distant or decentralized locations, as these can sometimes present higher fraud risks due to less immediate supervision. Questions about the communication of management's code of ethics are important. Is there a strong ethical culture?
Does the tone at the top filter down?
Right. They also ask whether management reports to the board on the effectiveness of internal controls related to fraud. They'll ask the audit committee about their oversight role and whether management or governance have received and responded to any tips or complaints regarding financial reporting, perhaps through a whistleblower hotline.
Checking if the feedback channels are working.
Exactly. For internal auditors, they'll ask about their fraud detection procedures and management's response to any findings they might have had. And they specifically ask about any significant or unusual transactions the company has entered into.
And what are they listening for in the answers?
Well, what's critical here is that inconsistent responses across different individuals, or responses that are vague or implausible, are immediate red flags. They signal a need for additional corroborating evidence. It's not just what people say, but how they say it, and whether the stories line up.
Makes sense. What's the second avenue for gathering info?
The second avenue is to consider the results of analytical procedures. These are evaluations of financial information through analysis of plausible relationships among both financial and non-financial data.
Looking for patterns and anomalies in the data.
Pretty much. Auditors are required to perform analytical procedures during the planning phase of the audit. They look for unusual or unexpected relationships in financial data, almost like a radar scan for weird blips.
Like what kind of blips?
Specifically, during planning, auditors are required to perform analytical procedures relating to revenue to identify unusual relationships that might indicate fraud. For example, if a company shows a significant sudden jump in revenue without a corresponding increase in its cost of goods sold, that might raise an eyebrow.
Selling more, but costs didn't go up.
Right. Or an unusual trend in sales returns right after year-end, maybe suggesting fictitious sales were reversed. However, it's important to remember that analytical procedures performed during planning often use highly aggregated, big-picture data.
So not super detailed yet.
Correct. It means they typically provide only a broad indication regarding fraud risk, not definitive proof. They are more like a wide net cast to identify areas for deeper investigation, a signal that something needs a closer look later on.
Okay, inquiries and analytics. What's the third way they gather information?
The third piece of information gathering is to evaluate the fraud risk factors we discussed earlier: incentives, pressures, opportunity, and rationalization attitude. The fraud triangle again.
Circling back to the triangle.
Exactly. The auditor uses their professional judgment to determine whether and to what extent these conditions are present within the entity, and if they indicate a heightened risk. It's a continuous assessment throughout the audit, not a one-time checklist.
And how do they weigh these factors?
Well, while the risk of material misstatement due to fraud is generally greatest when all three factors are present, the mere existence of all three isn't absolute proof that fraud has occurred.
Right, correlation isn't causation.
Precisely. Conversely, and this is crucial, the absence of obvious observations for any or all of the three fraud risk factors does not imply that there is no fraud risk. Even one strong condition, like overwhelming pressure on management to meet an impossible earnings target, combined with a very subjective accounting area, can be significant enough on its own to cause a material misstatement due to fraud. The auditor must remain acutely aware of these nuances.
So with all this information, the brainstorming, the inquiries, the analytical procedures, and the evaluation of the fraud triangle, how do auditors sort through it all to pinpoint the actual specific risks that could lead to a material misstatement? It sounds like a lot of data points.
It is a lot, and this is where they start to formalize and prioritize their identified risks. When analyzing a potential fraud risk, auditors consider 4 key attributes of this.
For attributes, okay.
They ask, what is the type of risk? Is it fraudulent financial reporting designed to manipulate the books? Or is it misappropriation of assets, which is outright theft? Knowing the type helps focus the response. Then they assess the significance of the risk. Can this particular risk, if it occurs, lead to a material misstatement in the financial statements? Is it big enough to matter to someone reading the financials?
Materiality again.
Always. Next, they consider the likelihood of the risk. How probable is it that this fraud will actually occur given the circumstances and controls or lack thereof? And finally, they assess the pervasiveness of the risk. Does it affect the financial statements as a whole, suggesting a pervasive problem like a weak ethical tone at the top across the entire organization? Or does it only impact specific accounts, transactions, or assertions, like an isolated inventory theft in one department?
So type, significance, likelihood, pervasiveness, that helps narrow it down.
Exactly. These questions help auditors prioritize where to focus their attention and tailor their audit procedures effectively. But here's where it gets really interesting, and a bit counterintuitive perhaps. There's a presumption of risk in every single audit.
A presumption, meaning they assume something is wrong from the start.
In 2 specific areas, yes. Auditors must presume that 2 specific risks always exist, regardless of their initial findings or their assessment of internal controls for that client.
Really? Which 2?
These 2 presumed risks are, first, improper revenue recognition, and second, management override of controls.
Wow. So even if everything looks squeaky clean, even if the inquiries are positive, auditors are required to assume these 2 forms of fraud might be happening. That's quite a mandate.
It absolutely is. And the implication is profound because it means these 2 risks must be specifically addressed with audit procedures. They cannot simply be dismissed, even if initial work suggests otherwise.
Why those 2 specifically?
Well, it acknowledges their inherent susceptibility to manipulation. Revenue is often the most critical number for judging a company's performance. making it a prime target for manipulation. And management, as we've discussed, almost always has the power to bypass the very systems designed to control them. So the standards basically say, assume these can happen and test for them.
That makes a lot of sense, actually.
Beyond these universal presumptions, auditors also consider several additional factors to further refine their risk assessment for that specific client.
Like what else?
They look again at whether and to what extent the three fraud risk factors, incentives, opportunity, and rationalization, are present in influencing specific areas. They also consider the size, complexity, and ownership characteristics of the entity.
How does size matter?
For instance, large, publicly traded entities often have more sophisticated deterrents, like dedicated audit committees, robust internal audit functions, or formal codes of conduct. These can help reduce risk. Smaller entities might lack these formal features, increasing opportunity, but they might possess a strong corporate culture driven by an ethical owner that genuinely discourages fraud. The auditor has to weigh these organizational nuances.
So it's not just big versus small, it's about the specific setup.
Right. They also assess the susceptibility of specific items to manipulation. Some accounts or transactions are just inherently riskier.
Which ones?
Items are more susceptible when they involve a high degree of management, judgment, and subjectivity. Think complex accounting estimates for things like asset impairment or the fair value of weird financial instruments. These provide more leeway for manipulation.
More gray area.
Exactly. They are also more susceptible when they involve highly complex accounting principles, where even experts might struggle with clear-cut interpretations, creating opportunities for, shall we say, creative application. Finally, auditors consider how fraud can be perpetrated or concealed not just by misstating numbers, but by presenting incomplete or inaccurate disclosures, or by simply omitting required disclosures. Fraud isn't just about the numbers on the page, it's also about the story the footnotes tell, and hiding crucial information there can be just as deceptive.
So looking beyond the balance sheet to the notes,
Absolutely critical.
once all these risks are identified and assessed, the presumed ones, the specific ones, it's not just about listing them, right? What's the auditor's strategic response to these potential landmines? How do they actually build their defenses and fight back?
Exactly. Identifying the risks is only half the battle, the other half is responding effectively. The first step in responding is assessing the risks while thoroughly considering the entity's internal controls.
So understanding the client's own defenses first.
Right. The auditor is required to gain a deep understanding of the entity, its operational environment, the applicable financial reporting framework like GAAP, and its entire system of internal control. Any assessed risk of material misstatement due to fraud is automatically treated as a significant risk.
Meaning it gets special attention.
Special heightened audit attention. Auditors must then identify and evaluate the specific controls that management has put in place to address these fraud risks, and critically, determine if those controls have actually been implemented and are operating effectively.
Checking if the controls actually work in practice.
Yes, specific controls, like a robust approval process for large expenditures, might mitigate specific risks. Broader controls, such as a company-wide culture promoting honesty and ethical behavior, can mitigate overall fraud risk. Conversely, any identified control deficiencies will immediately increase the auditor's assessment of fraud risk for that area.
Makes sense. So once risks and controls are understood, what's the response?
The auditor responds on 3 distinct levels, escalating their approach as needed. The first is an overall general response, which involves adjusting the entire audit approach to heighten vigilance across the board.
How do they do that?
This might mean assigning more experienced auditors or specialists to areas identified as high risk for fraud, ensuring the team has the necessary expertise. It also entails determining an appropriate level of supervision for engagement personnel, with more scrutiny for high-risk areas. Auditors must also critically evaluate management's selection and application of accounting principles, looking for any signs of bias that could lead to misstatements, really scrutinizing their assumptions. And a crucial, often overlooked element is to incorporate an appropriate level of unpredictability in the selection of auditing procedures from one year to the next.
Unpredictability, like keeping them guessing.
Exactly. Changing things up every year, maybe visiting different locations, performing tests at unexpected times, or choosing different accounts or transaction types to test in detail. This is specifically to prevent fraudsters from anticipating audit steps and designing their schemes around predictable audit procedures. This unpredictability is a powerful deterrent.
I like that. Keep them on their toes. So, That's the big picture, strategic response. What about more specific actions for particular fraud risks? Do they get more granular?
They absolutely do. And that leads to the second level,
Hmm.
a response encompassing specific audit procedures. For specifically identified fraud risks, the auditor alters the nature, extent, or timing of their audit procedures.
Nature, extent, timing. Break that down.
Okay. Nature means changing the type of procedures performed. For example, for a high-risk area, they might perform more substantive tests, like detailed transaction examination and sending confirmations to third parties, rather than relying heavily on testing the internal controls. Extent means increasing the sample size or the scope of testing. If a risk is high, they'll examine more transactions, maybe a larger percentage of an account balance, or even test every single item in a particularly risky population. And timing means performing procedures at different times. Perhaps doing more work closer to year-end, when financial results are finalized, rather than relying too much on interim testing done earlier in the year, which might miss last-minute manipulations.
So more detailed work, bigger samples, maybe closer to the finish line.
Precisely. It's important to note, though, that while the auditor's response may include both substantive tests and tests of controls, tests of controls alone are generally insufficient due to the inherent risk of management override.
Right, because management can just ignore the controls.
Exactly. Even a perfectly designed and implemented control can be bypassed by those at the top if they're determined. So you can't rely solely on testing the controls when fraud risk is high.
And that risk of management override, as you mentioned, seems to be a pervasive and huge concern. Does it get its own dedicated set of procedures because it's so critical?
Yes, it is so critical and difficult to detect that the auditing standards require specific, mandatory procedures just for addressing risks related to management override. This is a cornerstone of the auditor's fraud detection efforts.
What do those specific procedures involve?
First, they obtain a deep understanding of the entity's financial reporting process and controls over journal entries and other adjustments, and then verify that these controls have actually been implemented. Journal entries are a common way to manipulate results.
Okay, understand the process for adjustments. Then what?
Then, they systematically examine journal entries and other adjustments for evidence of possible material misstatement due to fraud. They scrutinize non-standard or unusual entries, particularly those made right at period end, or entries involving complex, subjective, or infrequently used accounts.
Looking for weird entries at the last minute.
Basically, yes. These can be prime vehicles for manipulating financial results. For example, a large, unexplained journal entry right before the books close that drastically increases revenue or decreases expenses without obvious support. They also review accounting estimates for biases that could result in material misstatement due to fraud. Management's judgments in estimates like the value of potentially obsolete inventory, the useful life of assets, or the allowance for doubtful accounts can be a significant area of vulnerability.
How do they check for bias in estimates?
One key technique is performing a retrospective review. This means comparing prior period estimates made by management to the actual subsequent outcomes. For example, if management consistently underestimated warranty expenses or overestimated the collectability of receivables in previous periods compared to what actually happened, that pattern suggests a potential bias that needs careful attention this year.
Looking back to see if they were always overly optimistic or pessimistic.
Exactly.
Yeah.
And finally, for management override, auditors meticulously evaluate the business purpose for significant, unusual transactions. They look for transactions that appear overly complex, perhaps structured in a way that obscures the economic reality, or those where the accounting doesn't seem to reflect the underlying substance.
Transactions that just look odd.
Yeah, odd, overly complicated, maybe involving related parties with no clear business rationale. These might be red flags for fictitious revenues or expenses, or maybe moving funds around to hide something.
So what do they do when they find one?
Procedures here may include obtaining and thoroughly evaluating all the underlying documentation, requesting proof of proper authorization from the appropriate levels of management or the board, and meticulously evaluating the accounting and disclosures related to the transaction to ensure they accurately represent the true underlying economics, not just the legal form. It's a deep dive into anything that doesn't smell right, specifically targeting that risk of management override.
So even with all this meticulous planning and specific procedures, what if something completely unexpected pops up during the audit itself? What kind of red flags might they encounter while they're actually out in the field sifting through the evidence?
It's true, the audit process is dynamic, and new, often unsettling information can emerge at any time. Certain conditions noted during fieldwork, while maybe not absolute proof of fraud on their own, can certainly suggest its possibility and immediately require further intense investigation.
Like warning signs flashing.
Exactly. Like flashing lights on the auditor's dashboard, signals that something is potentially amiss.
What are some examples?
For instance, discrepancies in the accounting records can be a major red flag. Things like missing documentation for significant transactions, large unexplained or unresolved differences when reconciling accounts, or lots of last-minute adjustments that lack proper support or explanation.
Sloppy records or missing pieces.
Right. Conflicting or missing evidential matter is another major concern. If management provides explanations that simply don't align with the documents the auditor finds, or if key documents that should exist are mysteriously unavailable or appear altered, that's highly suspicious.
Where did that invoice go?
Precisely. Problematic relationships between the auditor and management can also signal an issue. For example, if management is being overly aggressive in pushing for certain accounting treatments, unusually defensive when questioned, or attempts to unduly influence the audit procedures or conclusions, or maybe undue time pressures.
Management making things difficult.
It can be a sign. A very specific and deeply concerning red flag is objections by management to the auditor meeting privately with the audit committee. That bypasses a key independent oversight mechanism and limits transparency. It immediately raises concerns about what management might be trying to hide from those charged with governance.
That sounds like a huge red flag.
It is. Other indicators might include accounting policies that appear inconsistent with widely recognized industry practices without a compelling and transparent business reason, or frequent changes in accounting estimates that do not appear to result from genuinely changing circumstances in the business.
Changing estimates just to make the numbers look good.
If an estimate, like the useful life of an asset, constantly changes in a way that consistently benefits the company's reported performance, but there's no real-world logical reason for it, management bias could definitely be at play. Finally, a general tolerance of violations of the company's own code of conduct can signal a lax ethical environment where fraud might not just thrive, but be implicitly condoned. These are all conditions that demand a heightened sense of professional skepticism.
And probably trigger more digging.
Almost always leads to immediate expanded audit procedures.
So if they do find actual misstatements during the audit errors in the numbers, is it always just treated as a simple mistake, or can it point to deeper, more systemic problems with the company's integrity?
It's absolutely crucial for the auditor to consider whether any misstatements identified during the audit are indicative of fraud, rather than just being a simple error. This is a critical point.
Even small ones.
Yes, absolutely. Even immaterial misstatements caused by fraud can be highly indicative of an underlying fundamental problem with management integrity. While a small error might just be sloppy bookkeeping, a small, intentional, fraudulent misstatement, regardless of its size, suggests a willingness to deceive.
It's the willingness that's the issue.
Exactly. That willingness to deceive is a far more serious concern for the overall reliability of the financial statements and the ethical climate of the organization than a simple mistake of the same amount.
So what happens when they find something that looks like fraud?
When such misstatements are found, especially those indicative of fraud, the auditor may need to immediately reevaluate their initial fraud risk assessment. They might have underestimated the risk.
Okay, reassess the risk.
They'll also reconsider the assessed effectiveness of internal controls, as the misstatement might point to a control deficiency that wasn't previously identified or adequately addressed. Maybe a control they thought was working wasn't. And finally, they'll need to reassess the appropriateness of the audit procedures already applied. Perhaps they weren't robust enough, or they need to be significantly expanded in scope or nature. It triggers a rethink of the entire audit approach for that area, often leading to a wider, deeper investigation. Then, at or near the completion of fieldwork, the auditor must perform a final evaluation regarding the overall assessment of the risks of material misstatement due to fraud.
A final check before signing off.
Right. It's a comprehensive review, which usually includes further communication and brainstorming among all the key engagement personnel, pooling all the evidence and observations gathered throughout the entire audit. Sort of a final, does this all make sense? Check. This final evaluation might indicate the need for additional audit procedures if lingering concerns remain, if the pieces of the puzzle still don't quite fit, or if the results of the audit procedures contradict the initial risk assessment.
What if they still have major concerns?
Well, in the most extreme and serious situations, if a significant risk of material misstatement because of fraud remains, even after performing additional procedures, and the auditor simply cannot obtain sufficient appropriate audit evidence to reduce that risk to an acceptable level, the auditor should consider the drastic step of withdrawing from the engagement.
Just walking away.
Yes. This is not a decision taken lightly, obviously.
Hmm.
It signals a profound lack of trust and an inability to provide reasonable assurance on the financial statements. It's effectively an admission that the auditor cannot stand behind the financial numbers because a fraud risk is too high, or they're being blocked from getting the evidence they need. It's a last resort that underscores the gravity of persistent, unmitigated fraud risk.
That's a huge, almost unheard of step. But let's say they've found something, or they strongly suspect something significant, but maybe withdrawal isn't necessary yet. Who needs to know about this? What are the communication protocols when fraud is on the table? Is the auditor suddenly a whistleblower?
Communication is a vital aspect of the auditor's responsibility regarding fraud, and there are specific, often legally mandated protocols for who gets told and at what level.
Okay, who's first on the list?
First, communications typically happen within the company, with management and those charged with governance. Generally, any indication of fraud, even if it's considered immaterial financially, should be discussed with an appropriate level of management.
Why even immaterial fraud?
Because it might signal bigger issues, like control breakdowns or integrity problems. The discussion should usually be with management, at least one level, above those potentially involved in the suspected fraud, so the right authority can address it.
Makes sense. What if it's bigger? Material.
If the fraud causes a material misstatement of the financial statements, meaning it's significant enough to impact financial decisions, it must be discussed with senior management and reported directly to those charged with governance, such as the audit committee of the board. This direct, independent report is critical for accountability and oversight.
Straight to the audit committee.
Yes. Furthermore, any fraud involving senior management, regardless of its financial effect or materiality, must be reported directly to those charged with governance.
Even if it's a small amount involving the CEO.
Absolutely. Because senior management's integrity is fundamental to the entire organization's ethical tone and control environment. Their involvement, even in a small fraud, fundamentally undermines trust and must be addressed at the highest governance level. Auditors also consider whether any identified fraud risk factors represent what we call significant deficiencies or material weaknesses in internal control. These two should be communicated formally to senior management and those charged with governance, as they point to systemic weaknesses that could allow future fraud.
So it's mostly an internal communication up the chain of command within the company. But what about parties outside the company? Is the auditor ever required to blow the whistle publicly?
That's a crucial distinction. Ordinarily, the disclosure of fraud to parties outside of senior management and those charged with governance is not part of the auditor's responsibility.
So usually no public whistleblowing.
Usually not. The auditor's primary responsibility is to the users of the financial statements, fulfilled through their audit report, which provides an opinion on the fairness of those statements. Confidentiality regarding client information is also a key ethical principle.
But there must be exceptions.
There are very specific and limited circumstances where a duty to disclose outside the entity may exist, often driven by strict legal or regulatory requirements.
Like what?
These exceptions include to comply with certain legal and regulatory requirements, such as filing a Form 8K with the SEC, if a material event like the discovery of significant fraud or an auditor change occurs, or fulfilling reporting requirements under laws like the Private Securities Litigation Reform Act of 1995, which mandates reporting certain uncorrected frauds directly to the SEC under specific conditions. Disclosure may also be made to a successor auditor when they inquire of the predecessor auditor as part of their acceptance procedures. But crucially, this requires the client's specific permission.
Okay, successor auditor communication.
Auditors may also be legally compelled to disclose in response to a subpoena from a court of law. For entities receiving governmental financial assistance, disclosure might be required to a funding agency or other specified agency in accordance with the terms of that assistance agreement. And in some very rare and specific circumstances, disclosure might be made to authorities when management and those charged with governance failed to take appropriate corrective action after being informed of illegal acts or fraud. But these are explicit, legally mandated exceptions. Auditors aren't general whistleblowers by default.
Got it. After all this intense work planning, assessing, responding, communicating, documenting everything seems tedious, but it's absolutely crucial, right? For an auditor, That meticulous paper trail is everything.
It is absolutely everything. The documentation requirements are comprehensive and non-negotiable. Complete documentation of the auditor's fraud risk assessment and response is required by auditing standards.
Why so much paperwork?
It isn't just about covering their bases, though that's part of it. It's about providing a clear, logical, and defensible record of the entire audit process, demonstrating the work performed, the professional judgments made, and the basis for their conclusions. It's their audit diary, their evidence locker, all rolled into one. It shows they followed the standards.
What specifically must they document?
Specifically, auditors must document the planning discussion among engagement personnel regarding fraud risk, detailing how and when the discussion occurred, who participated, and the specific subject matter discussed, like how fraud could occur. They must document the procedures performed to obtain information related to fraud risk, like the inquiries made of various personnel or the results of analytical procedures conducted. They also need to document specific identified risks of material misstatement due to fraud at both the overall financial statement level and the individual assertion level, clearly linking them back to the fraud triangle components or other factors.
Documenting the risks they found.
Yes, and also, any identified controls in the control activities component that address the risk of material misstatement due to fraud must be documented, along with the results of any tests performed on those controls. And remember that presumption about revenue recognition. If the auditor has concluded that improper revenue recognition was not identified as a significant fraud risk for a particular client, they must specifically document the support and detailed reasoning for reaching that conclusion.
So they have to justify not finding that risk.
Exactly, because it's presumed otherwise. They must also document the results of all procedures performed, especially those critical procedures designed to address the risk of management override of controls. And finally, the nature of all communications made about fraud, who was informed, management, governance, etc., what was said and when. This meticulous documentation provides transparent evidence of the auditor's compliance with professional standards.
That's a serious paper trail.
It has to be. And this commitment to documentation, accountability, and the fight against fraud was profoundly reinforced by a landmark piece of legislation, the Sarbanes-Oxley Act, or SOX.
Ah, SOX, that came after some huge scandals, right?
Exactly. SOX was enacted in the U.S. in 2002 after a shocking wave of major corporate accounting scandals like Enron and WorldCom, where widespread fraud led to massive investor losses and really shook public confidence in financial reporting.
A real crisis moment.
It was. SOX was essentially a national wake-up call. It introduced much more severe penalties for those who destroyed records or willfully failed to maintain audit documentation for at least 7 years. It also imposed harsh penalties for committing securities fraud or for executives failing to certify the accuracy of financial reports. It also significantly extended the statute of limitations for the discovery of securities fraud, giving victims more time to pursue legal action. And crucially, it provided robust legal protections for corporate whistleblowers, encouraging employees to come forward with information about fraud without fear of retaliation. SOX fundamentally changed the landscape of corporate governance and auditing, pushing for much greater transparency, accountability, and a significantly stronger stance against financial deception. Hashtag tag outro uptro.
That was an incredible deep dive into the high-stakes, cat-and-mouse world of fraud risk from an auditor's perspective. Really fascinating stuff. So what does this all mean for you? Well, you now clearly understand that financial fraud is fundamentally different from a simple error. It's characterized by that deliberate intent and deception, often with complex layers of cover-up. You've learned about the two main ways it manifests: manipulating financial statements to make a company look better than it is, fraudulent financial reporting, or outright theft of assets misappropriation. And you now have a shortcut to appreciating the fraud triangle, that powerful alignment of incentives or pressures, opportunities, and rationalizations that typically creates the conditions for fraud to occur. Crucially, you've seen that auditors have a structured, rigorous, and dynamic process to assess and respond to these risks. They operate with that vital mindset of professional skepticism, constantly challenging assumptions, even their own. But it's an ongoing challenge, an intricate dance between intentional concealment and determined detection, requiring constant vigilance and a clear understanding of where responsibilities lie. Management owns prevention, auditors provide reasonable assurance. It's not about catching every single penny stolen, but ensuring the financial picture presented to the world is materially true and fair.
And this raises an important question, doesn't it? Given the inherent, almost insurmountable challenges of detecting sophisticated, well-concealed fraud, and the fact that auditors provide reasonable, not absolute, assurance, Well, what does this tell us about the delicate balance of trust and skepticism required? Not just in auditing, but really in all aspects of business, and maybe even in our daily lives as we process information. How do we as a society build systems and foster cultures that truly deter such intentional deception rather than just reacting to it after the damage is done? And what is our role as informed citizens, investors, or even employees in recognizing potential red flags and demanding accountability? Because ultimately, financial integrity isn't just the auditor's job, it's really a shared responsibility.
Powerful thoughts indeed. A lot to chew on there about trust, systems, and our own roles. Thank you for joining us on this deep dive into the complex, often hidden world of fraud risk. We hope you'll take these insights with you and continue exploring the fascinating layers beneath the surface of the world around us. Until next time, keep digging deeper.